Hello and welcome. My name is Oscar and I'm from the Finance Society at Stockholm Business School. This is the first of a kind of video series where we will discuss technical analysis and how it works, what it is, how you can use it in your own trading or your own analysis on different stocks. To start off, we will learn how to read the actual charts, because there are tons of different ways to draw charts. But I thought this would be a good way to start off and be able to read the charts. Next week we will go into more what is technical analysis all about, but the fun thing is to read the charts, and this would give you a sufficient base to start reading or trying to understand what's going on the charts. Let's start the presentation. Price and time. You have an x-axis and a y-axis. On the y-axis you got prices, like in dollars or euros, depending on where the stock is trading, of course. Or you can have a ratio for like the US dollar versus the British pound. On the x-axis you have time. Time can be like from the left side to the right side. It can be during a day. So 1 hour, 2 hour, 3 hour, 4 hours. It could be 2006 here and 2013 here. So it depends what scale of time you have. Of course, if you want to trade the intraday, you're going to have a smaller time frame here. Let's see. We have 3 different charts today. I will look at the line chart, a bar chart, and a candle chart. There are pros and cons of all of these, but we will look into them real quick. The line chart is probably the most commonly used in textbooks and what you see in like papers. The line chart is just connecting the dots. Every close, the closing price of each day is a dot, and you just connect the dots. So if here it closed at around 70, next day it was 75, then you just draw a line between those two dots. Like you can see here, it closed there, it closed here, it closed here, and then you just connect the dots with straight lines. The price is that you can really easily see what's been going on. It's been up here, and it's gone here, and it's gone flat, and then it's gone down again. So it's very easy to see what's going on in the long run. What you don't see is what happened during the day, because maybe here it started here, went up to 85 during the day, it went down to 65 during the day, and then just came back to 75 and closed. This is very important information. Not very likely that it will move $40 a day, but it can happen. This is information you don't see in a line chart, so that's just something you need to know. This is why I don't personally use line graphs, but it's good to know. A bar chart. A bar chart is another way of showing the data. If you look on the bigger scale, like we have it done here, it's 2008 to 15. It's a bit messy and it's not very easy to see what's going on. But the bar chart it's pretty good. On the left side here, you have a horizontal line. That's the opening price of the day or the year or whatever time frame you have. As in the line graph, this can be one day to another or 1 year to another. It all depends on the time frame. Same thing with the bar chart. Each bar can be a day, it can be 5 minutes, it can be a year, 10 years, whatever. But the left horizontal line is the opening of the session, even if it's 5 or 10 minutes or a day. So this is the open, this is a close. This is the high, the top of the vertical line, and the low of the day, or the session I should say, is the bottom of the horizontal line, sorry. Here we have a zoomed in version of the first picture of the bar chart. As we can see here, let's take here, I hope you can see the cursor. We opened up. During the day we went down a little bit, we then went massively up. We did new highs. We didn't close at the highs. We went down a little bit again. So let's say it started at 73. It went down to 72.50. It went as high as 77 and it closed at 76. This info you don't get in a line chart. You just get that it's closed here the day before and it closed here the other day. So it's just a straight. It doesn't show the action during the day. In this case, it wasn't really huge, so I didn't show it, but we will see examples where it's more important. The negatives of the bar chart is, as I said, when you zoom out, it gets really messy. It's not really easy to see what's going on. But again, these are, I think, dailies. No, these are weekly bars, so each bar is a week. So you can obviously put them as months, and it will be easier to see what's going on. But they are just so bland. Well, you can have different colors, like green if they're positive bars and red if they're negative bars. I've never used bar charts myself to a great extent, so I'm gonna have it unsaid if it's good to have them in different colors. But they give more information than the line chart. Now, candlesticks. Candlesticks is my favorite chart. I would say it's used by, I don't dare give you a percentage, but a very large majority of technical traders. This gives you very good information. It's very easy to see just by looking at it that what's been happening in the chart. It's very much like the bar chart, but it's different. Of course, because it's not the same thing. To start off, again, in this case we have green for positive bars. That means like it opened at 100 and it closed at 110. So it's a positive day in the markets. We use a red candle if it's a negative day. Let's say it opened at 100 and it closed at 90. That means it's a negative day, it's a red bar. In a green bar, we have the open in the bottom of the candle and we have the close at the top of the candle. We have these wicks or shadows. It's a candlestick, so I usually refer to them as wicks because you have wicks on candles, obviously. And the top wick is the high point of the day for the stock, and the bottom wick is the low point of the day for said stock. In the red candle, you have, again, the top one, in this case, is the open, and because it closed lower, the bottom line is the close of the day. Top wick is the highest achieved price during the day, and the bottom wick is the lowest price on the day. So you get loads of information here. Let's see in the next chart. As we can see, I just take a random one. Let's just take this one over after this red one. It opened, it went down a little bit, it went up, made new highs, and went down a little bit again, and closed. So it didn't close at the highs. If we look at this one instead, it opened, it didn't go up anything, and it went all the way down, and it closed at the absolute bottom of the day. So this is information we wouldn't get from a line graph, for example. I will give you a good example. This one here, this is also known as a bottoming tail, but that's we'll come to that later in the series. What this means is that it opened, it went massively down, it retook all the losses, and it closed higher on the day. This is very, very valuable information, but in a line graph, we wouldn't see it. We would just see going straight down and then just sideways. Here we see it. We go straight down and they go sideways. In this graph, we see that it went down and up again on the same day. But in the line graph, it just looks like a calm day in the market, nothing happened. While in other hands, it was actually a very hectic day where loads happened. So again, you get loads more information with the candlesticks. And I think they're pretty easy on the eye as well, because you can just look at it. At least me, I've used them for a couple of years. It's very, couple of years sounds long, but you get it within the week. It's very simple. Some people don't use red and green. I know some people are colorblind. Some people use black bars for down days and white bars for up days. Some people use it the other way around, but I know the majority of black and white people use black for down and white for up. Yeah. To summarize, today we have learned about 3 different charts: the bar chart, the candle chart, and the line chart. I hope you found this interesting enough. Maybe it was too easy. Don't be hesitant. There will be more advanced stuff coming out, but I think we need to let people come up to a certain level before we start digging in the more interesting stuff, because this is very, very basic. Next week I will try and do more what is technical analysis, what is it used for, and more compared to with the fundamentals. Maybe I should have done that first, but I just think this is more fun. All feedback is very welcome. Put them in the comments or send an email to the Finance Society, and I will get the critique. Positive and negative feedback is always welcome. Thank you for your time, and have a good weekend. Bye.